Welcome to the Taxes Saved Case of the Week. We are super excited to share with you specific cases of real clients, like many of you watching this, so that you can understand the magnitude of timing as well as the compounding of taxes and what that actually means to you, right? There's a lot of noise out in the marketplace of when does a Roth conversion make sense? When does it not make sense? For high income earners, heavy savers, and IRA 401k. You're who we're talking with. And so here's what we're going to go through. We're going to actually take you through a case today. And it's actually a case that we pulled from last week. And we're fortunate to have the opportunity to consult with clients from all around the country to help them understand how to navigate tax savings, not just doing taxes, but how to save taxes, right? There's a very distinct difference between those who tell you how much you owe and those that can actually teach you how much less you have to pay. And in our mind, and what we've seen time and time again, in my experience working with baby boomers now for 3 decades, taxes are typically not a hot topic, right? It becomes a hot topic when they have to start paying more than what they realized. And it generally is not something discussed with their traditional financial planners or what we call kind of the big box store brokerages, because there isn't any way for those brokerages to make sense of that, right? They don't really understand taxes, and most people, unfortunately, that we work with end up giving up a lot of taxes that aren't necessary. So here's what we're going to go through. We're going to actually take you through a case with a gentleman who's 63 years old. Why should that matter to you? Keep in mind that particular number or that age is a very crucial age in what we call the dynamic decade or the retirement red zone. And that dynamic decade is ages 63 to 73. Well, why? Why 63? Well, there's this thing called IRMA, right? Income related monthly adjusted amount, where you actually get taxed on your Medicare. And it doesn't happen for 2 years. So a couple things I want to make sure that get pointed out here is I'm excited to introduce you to Davis Oliver, my oldest son. He is instrumental in spearheading this whole division of tax planning with these strategies. And there's a number of strategies. We're going to get right to the point on this, but we're going to take you through the case, show you how somebody avoided the Medicare tax, right? Medicare Part B and D tax surcharges, they call it, how they were able to actually remove over $1.6 million of long-term taxes over this particular client's lifetime, and how not only getting reducing required minimum distributions, right, which would be forced upon him at age 75, but completely eliminating them. And not only eliminating those, but also preventing leaving a large tax burden to his heirs. So without further ado, Davis, I'm going to turn it over to you, and we'll go through the case. We'll point out some key points or pieces to the case, and then we will wrap up. So Davis,
Yeah.
take them
Thanks,
away.
Dad. Thank you. So this one's really exciting. I was excited to go through this one with you. This is a client we've been working with for about 3 years now, or at least two and a half, right? And we've done some sizable amount of Roth conversion, right? And so this client is a single filer. So those brackets he's running up against are a little bit more hefty than those joint filers out there, right? But not only that, but some other things going for this client is he's in some investments that have had some great appreciation in these tax deferred accounts, right, Dad? These IRA accounts that we have for clients where we can not just invest in public equities, but also some private equity that is done really well. So that's a known part of this amount of that was Roth converted this past year for him, getting out ahead of the known appreciation. Two of those funds that he's in we're having, right? So we're even saving him tax there. So a lot of that was fundamental in this plan for 2024 for this client. So go ahead and break this down, right? From the strategy implemented to what his income, his tax burden he was looking to face, and now what he's really left with from this year of 24 tax savings. So as you mentioned earlier, Dad, the long-term tax savings by getting out ahead of this RMD risk, the required minimum distribution risk of taxes being over 1.6 million. So this was a fun one for sure. So I'll go ahead and break this down. So this client's profile, right? Single file out of the state of Colorado, as you see here on the return, right? He's an engineer, right? And so he's got some W-2 income, right? And you'll see here about 179, about 180 grand, we'll round up here, right? So he's got some dividend income, right? And then he also has as you see here, big taxable amount being this IRA distribution he made being a Roth conversion of $638,395. So adding all this up, we've done the math for you. we're at 827,000 of taxable income, single filer in the state of Colorado, right? So what is the burden he's looking to face, right, with this conversion tax as well as the ordinary income tax he has on his salary? We're looking at 294,000 and some change of tax, state and fed he owes on this income, right? He's at a 35.5%, 35 point, sorry, 6% effective tax rate before any strategies are implemented. Right? So what do we do for this client? Right, this is a great strategy we use called Section 179. Right, so for you that are just listening and aren't a business owner, maybe aren't familiar with the tax code as much as what our team helps clients with, part of what we really do is what 179 is all about. For those that are first hearing this, if you have an active business you work along with, and you have an equipment expense, right? So equipment expense for the business, from software to computers to heavy machinery, whatever that looks like, right? In this case, we're able to tap into a short-term equipment leasing business for this client and help them with this strategy, right? If you have an equipment expense of up to 1.25 million, right, you can write that off for married filing joint couples all against your active income, right? In this scenario, right? So that's where this is coming from in tax code. Section 179, been around since 1958, been around quite a while, right? So with this client, we were able to, minimum of this program, be able to put $30,000 down, right, on his equipment business. That's what his out of pocket was here, Dad. And we were able to borrow, as you know, doing the strategy ourselves, 270,000, 90% loan to value with the commercial lenders we help clients with in this program, borrow this money to where it's also getting paid back for him. So now he has a $300,000 equipment expense across 4 pieces of equipment. But again, he's out of pocket 30 grand, right? So that's what this strategy is about. Of course, for clients that are just hearing it, if this strategy is fitting for you and working with our tax team, we'll happily go into much more detail. But for time scenario today, right, this client now has a $300,000 deduction in this equipment business he has here, right? So where do you see that, right? So now on his tax return, I'll draw you back over here to line 8, right? You'll see this parentheses $303,004 loss, right? So this is the strategy he now has here. So before the strategy, right, I'll zoom in here so everyone can see, right? You'll see he had a taxable income of $827,000, right? And now his tax burden on that's 294 grand at that 35.6% effective rate. But after his $303,000 loss, we went from 827 of taxable income he owes tax on to $508,000. His new tax burden, instead of 294, is 164,997. His effective rate went from 35.6 after his deduction to 19.9. Right? And so you'll see here now, right? What did this client walk away with in first year tax savings, right? So this is the first part of his plan, right? Of what he really got to walk away with of ROI, right? It always comes down to the ROI, as you know, Dad, and making sure clients understand this. And so he walked away with $129,000, a 433% return on his $30,000 investment, right? So he saved in first year about $130,000 in taxes, right? Strong multiple on his outlay for that year of 24 to save that tax, right? So this is kind of, you can see the excitement here, right? This client now has everything, right? This is the really exciting point for him. Not does he ever have to worry about RMD ever again. He is completely done with the RMD risk he was facing before working with us. After 2.5 years of working with us, this is the last bit of IRA that he is now all in growing and compounding in a Roth account, right? So this one's really exciting, just on the short-term tax, you can see, Dad.
Yeah, and let me jump in there. So we see cases like this every week, and I love the doubting Thomases that, hey, I've ran some Roth conversion analysis, and my favorite is, my CPA says this, and so on and so forth. Unless you have tax saving strategies, for a lot of people, a Roth conversion may not make sense at all. I mean, especially where you're getting your liquidity, right? If you're going to just pay the tax out of your pocket. I want to reemphasize this. We're teaching people how to not pay the tax out of their pocket by using paper losses, right? Like this 179 deduction that this client again, this is just the savings he had for the first part of his plan for 2024. But now, right, there's more tax savings. We're even doing this for client for 2025. So as we transition here, I think you're going to go into, Davis, showing the long-term tax savings effect of how people, in this client in particular, being an engineers, what I would call him, didn't realize that on this, 600, we'll call it $638,000, how much his cumulative tax was going to be over his lifetime. And this is what we see all the time. I mean, we see this all the time. People will either be a doubting Thomas and they'll discount, right, the idea that there's really ways for them if they're just W-2 earners, or, if they're self-employed, maybe they thought they've seen every tax saving strategy. Or many of you have reached out and said, look, I don't have a tax planner. I've got really someone who just numbers in, numbers out, and pretty much reports the damage and attaches an invoice. Folks, that's not tax planning. That's just tax accounting. And for many of you, it's very likely that you're going to face more taxes than the people that are actually doing your taxes. So why would they have a motivation of wanting to save you tax if they really don't have a motivation for themselves to save tax? So as we transition, Davis, let's share
Yeah.
with them, those watching, the long-term effect of these ticking tax time bombs I've written about, I've spoken about for decades. And here's the key: the timing of this, folks, with the Tax Cut and Jobs Act sunsetting. And what does that mean? That means what Trump put into office that took effect in 2018 in his 2017, this legendary tax savings bill is expiring. And there is infighting like crazy already. I mean, the first pass with the House failed. They're trying to get it passed again. They came in and did a bunch of stuff over the weekend. Depending on when you're watching this, and the reality is, we don't know how much is going to get passed or not get passed. Here's the deal: if it doesn't get passed, about 60% of the population, it's projected, are going to see their taxes go up significantly, because all the brackets are going to go up, and unfortunately, the deductions are going to go down. And so the timing of this is so important. And you want to catch this ideal rebound, right, from this Trump slump to this Trump bump, with catching that rebound tax free. You don't want to catch this rebound tax deferred. Otherwise, you're just going to compound your future tax. In this example, Davis, let's take them through. We'll really emphasize how tax deferral can be very dangerous. So I'll turn it back to you.
No, it really is, Dad. I think that's why Warren Buffett considers compounding interest a wonder of the world. It's great when it's in a tax-free environment, right? Because we want that baby to grow, grow, grow. But when it's in a
Right.
tax-deferred environment, it's just that much more of a risk that we're having to pay the piper on. So this is exactly the plan we did for this client, right? So this client, as you can see here on the screen, we can, for clients that, want to see these numbers for themselves, this is a great thing, in a Hidden Wealth tax discovery meeting, we can share with you, right? We want you to see these numbers for yourself, to really help you, right? We feel that a lot of clients are being disserviced by not seeing these numbers. So for this client, age 63, right, with what he's got left in tax deferred value of IRA money, $638,395, right? And here for this client, I'd say the growth rate here we have is conservative. For again, a big part of this 638 being converted has about a known growth rate of about 60%, right? Uh, from last year, right? So we wanted to make sure we got out ahead of that before, 200 grand goes up 60%, right?
Yeah.
Here we're just showing, you can see, right? That's the fundamental for this plan. We're just showing him after fees, a 10% growth rate before, and after an expense of someone maybe managing that money, 9%, right? So this money from age 63 in this analysis kills everyone off at age 90. Not that we're trying to kill people off. That's just the life expectancy age this analysis has for everyone. So 9% growth, then we give it a tax liability, right, on what this client's gonna be paying on RMD taxes. And like you just said, Dad, I think us and our clients, even with the uncertainty in Washington of this big, wonderful bill up for proposal here, taxes are not going to be going down. We don't see that as a strong likelihood, right? We're no Nostradamus, but we don't see where there's a world where taxes are coming down historically to where they are today, right? Many think it's the lowest they've ever been historically. So here for this client, we just show a marginal rate of 25%. Is what he's going to be paying as he distributes this money out from RMDs, et cetera, over the next 27 years. So now we're about to show you a big ugly number, right? But this is exactly why the math made sense for this client to get rid of that tax risk he had on that $638,000 tax deferred money, right? And so you'll see here, right, on the left, he does nothing, right? We don't do any Roth conversion, no strategy implemented on RMDs alone, right? So when the government forces for this client being born after 1960, his first RMD age is age 75, right?
Yeah.
And so that's when the government requires his first RMD, required minimum distribution, to come out of this account, right? So from age 75, so again, not for another 12 years, this client isn't worried about this. But again, that's 12 years of compounding risk. But in 12 years from now, from 75 to 90, so 15 years, he'll pay in RMD taxes alone 580,000, again, on what's $638,000 today. So that's ugly. The next one, what this next row is showing, is if you, let's say, the biggest cardinal sin, we see this all the time. I mean, how many of our clients say, help me, I'm paying more in, RMD taxes than I was in my highest earning income years, right? So we realize for a lot of the Gen X boomer population, a lot of you aren't spending these RMDs fully, right? So you're reinvesting them as you should, right? But what are we doing there? We're putting these in interest, dividend, money market, of course, growing our money, but we're also having to get hit some tax there as well. So that's what this is showing. You're not spending the whole RMD and reinvesting that, and being another $336,000 of tax over the life of that accounts till age 90. And then for the clients that are out there that are worried about legacy, this would be a very much a motivated reason to why you need your own tax Roth conversion plan. Is when this client passes, right? He'll leave this tax deferred money and what's left. This is amassed to, and we'll show you those numbers here in a second. And his inheritors have 10 years to spend that down, and it's all taxed on top of their earned income, right? And this is the other cardinal sin we see, right? Or not really cardinal sin. You can't control it if you don't have a plan. But right as most people are about to expire, again, killing some people off here, usually they're adult kids, we see this with clients, are in their highest earning income years about to retire, right? So they're just getting double hit with, of course, what, the parents want to leave as much as they can to their kid, not Uncle Sam. Uncle Sam knows this, predicted this, created this to get their fair cut, of course. So all combined, right, that's another 747,000 of legacy tax. We add all of this up, the total tax risk he is now eliminated, will never, even if these variables are skewed slightly off, $1.6 million of tax risk he's no longer having to run up against, right? So if we scroll down here, you'll see, all right, I'll zoom in here, is you'll see this money compounding, right? He's age 63, his IRA value goes up and up and up, again, at that 9% growth rate. Quite frankly, his account's even gone up higher than that. Accounts. And by age 75, as you see here, right, the math numbers start changing, where you see at 75, he's got his first RMD, right? Where $638,000 is now compounded to $1.884 million of tax risk he has. And so that first RMD for him is about 73 grand, but after tax, he's only taking home 54,000. Unfortunately, as we see that, as you know, this just keeps getting worse and worse. Close to 90 is about $250,000, 243 of RMD. He's only taking home 182, right? His account value is almost 3 million bucks, right? Even after the RMDs he's taken over the past 15 years now, right? So this is, again, I would agree with you, Dad. For some clients, right, and depending where they're funding these strategies, things like that, but with strategy, it always makes sense to Roth convert, and the math always has to math. Without strategy, for some clients, it might not make sense, right? So we encourage, and that's what we do. We really help clients build out, look at the numbers, look at the strategies, get their feedback, and what really makes sense for them to outrun this large task risk, right? It's great that we save the client, right, to go back 129,000 of income tax in 24. That's phenomenal, right? Especially for an outlay at 30 grand. But what's even more exciting is we didn't just do that. We also got him out of ever having to face this $1.6 million of tax, right? We've literally, and you coined it, Dad, but I got to give credit where credit's due. We've made him a tax-free retiree from the perspective of never having to worry about RMDs. And
Yeah.
that's the funnest thing, when we really get to see the ROI of what a client's received in their tax plan.
Yeah, and it does a couple things. So, if you cut that, I mean, he has still a decently high taxable income for
Mhm.
2024. So we have a little bit of a, an ounce of pain, right, for pounds and pounds of gain, so to speak, on that one isolated year of IRMA tax, right, on his Medicare, which goes
Yeah.
out 2 years in the future. However, if we calculated, which we won't take the time to do that, but if we calculated all the IRMA tax that he would have paid had he not gone down this path, on top of this gentleman now being able to basically cycle all of his income through tax-free IRA, Roth IRA, excuse me, distributions, he also saves a mountain of unnecessary Social Security taxes.
Yeah.
And so by the time what people don't realize is what I've called for years the torpedo of taxation, right? So when one thing detonates, it detonates another thing, right? Somewhere else, blows up. And it's the same thing. The required distribution causes higher income tax, causes some people to bust through the brackets. And then all of a sudden, right, their Medicare gets taxed indefinitely. They don't know how to stop it, as opposed to an isolated instance like this, and then their Social Security gets taxed over a lifetime. And some people's Social Security tax, with this gentleman already being basically penalized being a single tax filer because he's busting through the brackets that much faster,
Yeah.
is there's several hundreds of thousands of dollars, folks, that aren't even in this calculation that you're seeing right now. So this is why it's so important. Let's go back through this. Here's a client, and let's just say he's an engineer's engineer, and a Downey Thomas would be very fitting for this particular client. He's on cloud nine now, but let's just say there was quite a bit of resistance and hesitancy till he could see the math. And this is where we see a lot of people, unfortunately, not take advantage of this. They hear things, they assume things, and no one proves the math. So here's the math. And one of the things that we want to reiterate here is not only did Medicare get only hit one isolated year because he's completely he's got his IRAs and his income out of the tax system, which is very, very obviously very positive to him and for his future family, inheritor, so to speak. But he's also, right, in his particular case, he's become a tax-free retiree because now his Medicare won't be taxed again. His Social Security won't be taxed because his income is being derived from Roth IRA income, and his heirs won't be taxed. And so to go back over that, it's so important for people to understand. Now, what's the long-term tax effect? Well, we're going to help him as he makes this transition, get his taxable income down even further with other strategies. But remember, we only used one strategy in this particular case study so that people could see going from over a 35% bracket down to under a 20% bracket and removing an enormous amount of tax burden. But here's the kicker that I want to leave people with. This is assuming a 25% tax rate, whoever's going to inherit this money. And we've got clients right now that, let's just say their heirs are already, let's say, in high income tax states, and maybe their combined tax rate is like 40 to 50%. So if these numbers are very discerning in them, discouraging and discerning in themselves. Imagine the clients we meet with, like many of you may be watching this, who have high income earning adult children in high income tax states. And then the math gets even uglier. So I would go to taxessave.com just as you're picking up and seeing this. There's a place for you right below this case study where either through this information that we're providing to you or an actual link that you can click, and it'll take you right to a calendar if you want to just scroll down and put in the best time and day that actually works for you. And we go through this. Everybody deserves to have a strategic tax plan. And if you don't have one, overall, you really don't have a plan. The government has a better plan for you than you do. So take the initiative. Don't doubt. Form your own opinion, right? Suspend your disbelief, as I've tried to share with people for the years. And I wish I had $1, Davis, for every client that said,
Yeah.
wow, I didn't know you could do it this way. Or, my person thought, my income was so high, like why on earth would I ever do a Roth conversion?
Or
Well,
I thought it was too late. I hear
yeah, they
that.
thought it was too late. Or we have a number of clients that come to us in their mid to late 70s saying, hey, I'm already drawing my required distributions. Is there anything I can still do? You can still benefit, especially before this Tax Cut and Jobs Act is, again, a friendly reminder, may not all go through in having it extended. So you'd rather have a bird in hand than chasing two in the bush, as we like to say. Know what you know now with the uncertainty. And I'll leave you with this analogy. If you had a business partner and you had an agreed upon, right, relationship of stock ownership. So let's say you were 50-50, but all of a sudden that business owner decided in the end, right, or on an annual basis, hey, I think you should have less maybe instead of this year 50-50, I think you'll be 40, I'll be 60. And then the next year, you'll be 30, I'll be 70. Folks, that's what an IRA does to you. You have no idea, right, what the government's going to come back as your business partner and stake the claim of what higher ownership they choose or decide to take. In this case, let's just get the government and the IRS out of your income, out of your IRAs, and out of your inheritance. And you can do that, folks. You worked hard for your money. Imagine a proven track record of measurable results using tax code that's all above board, everything straightforward. We have a great team of CPAs that not only understand the strategies, support the strategies, and use the strategies themselves. But this is what it takes, right? It takes a plan. So we call it the STOP plan, stop overpaying taxes, the saving tax optimization plan. So if you want to see your numbers, see your math, and see what you can do to solve taxes, take advantage of that today.
Yeah. Thanks, Dad. This one was great. Look forward to next week.
Likewise.